You know that feeling, like when you're running on a treadmill and you accidentally hit the speed button a few too many times?
Oh, yeah. Suddenly you aren't running for fitness anymore. You're just, sprinting for your life to try and stay on the belt.
Exactly. And your only coherent thought is just survival.
Right.
So you panic, you slam that big red emergency stop button.
And the belt just violently jerks to a halt.
Yeah. And you're just standing there gasping for air, holding onto the rails, wondering if you're about to fall backward.
I mean, you survived the sprint, but now you actually have to figure out how to step off without breaking your ankle in the process.
Which is terrifying. And honestly, that is exactly what it feels like to look at Peloton right now.
Oh, for sure.
So, welcome to the deep dive. Today, we are taking on a pretty massive mission. We're slicing straight through the incredible noise surrounding Peloton ticker symbol PTON for those watching the charts.
There's so much noise right now.
There really is. And we want to figure out if this former pandemic darling is a massively undervalued turnaround play, or if it's just a value trap.
Like, is it just trapped in a falling trend and destined for zero?
Exactly.
And to give you the clearest picture possible, we've actually pulled together a really diverse stack of sources for you today.
Yeah, we've got some great stuff.
We do. We're looking at recent insights from activist investor Eric Jackson from EMJ Capital,
Right.
along with a really deep technical and fundamental market analysis and a comprehensive long-term financial evaluation by a CFA, a chartered financial analyst.
So what does this all mean? Well, I mean, it means the stakes are incredibly high for you.
Yeah, absolutely.
Like if you've got a $2,000 Peloton sitting in your living room right now, you might be wondering if that screen is just going to, go dark next year.
Which is a real fear.
It is. Or if you're watching the market, you're wondering if this is the cheapest tech stock of the decade.
Because we are looking at a stock that was once flying into the stratosphere. I mean, truly.
Right. And today, it has plummeted to around the $4 mark.
$4. It's crazy.
But yet, beneath the surface of that $4 price tag, there is this wild, just violent tug-of-war happening.
Yeah, between institutional buyers, short sellers, and, everyday retail investors.
Exactly. But to understand where the stock is going tomorrow, or like next year, we first have to look at how the company got into this mess in the first place.
Right. The transition from those hyper-growth pandemic days to today's incredibly harsh reality.
Right. The historical hangover, basically.
So let's get into the context of that crash.
Right. Let's look at the psychological and financial backdrop here, because during the pandemic, Peloton's revenue absolutely exploded.
It was unprecedented.
It was. It went from $219 million in 2017 to $4 billion in 2021.
Wait, $4 billion?
Yeah, $4 billion. That is a 20x increase in revenue in just, 4 to 5 years?
20 times. I mean, that number is just hard to comprehend for a company selling heavy physical hardware.
Right. This isn't just software you can instantly download. Exactly. It takes an enormous logistical effort to scale physical manufacturing and shipping at that kind of pace.
Well, and because revenue was literally doubling year over year, even before the pandemic, actually, in 2018 and 2019, the previous management team started making decisions as if that growth curve was a permanent law of physics.
Right. Like the treadmill was just going to keep speeding up forever.
Yes. So they aggressively expanded. They acquired a manufacturing company for hundreds of millions of dollars.
Hundreds of millions. Wow.
Yeah. And they added vast new overseas facilities, plus a massive new manufacturing site right in the United States.
All simultaneous.
All simultaneously.
I mean, they essentially built an infrastructure designed for a world where everyone stayed inside forever.
But then, the gyms reopened.
Right.
And revenue fell by 11%.
Ouch.
Then it fell by another 22%.
Oh, wow.
And it has declined every single year since. But, and this is key, the revenue drop itself wasn't actually the fatal blow.
Really?
Yeah.
What was?
The real tragedy was that they had locked themselves into rigid, fixed-cost supply agreements.
Ah, I see.
Yeah. If you sign a massive 3-year agreement to purchase microchips, screens, and, raw aluminum from a supplier at a certain volume.
You can't just cancel it when your consumer sales dry up.
Exactly. Not unless you want to pay staggering penalties.
Right.
So they were bleeding cash, just holding on to inventory they couldn't even move.
It's like getting a massive, unexpected bonus at work, using it to buy a 10-bedroom mansion, and then immediately taking a massive pay cut.
That's a perfect way to put it.
Right. You're stuck with a mortgage you can't easily change, and the bank does not care that you aren't making as much money anymore.
Nope. The fixed operating expenses stayed astronomically high while the sales plummeted.
So if you're the new CEO, Peter Stern, taking over this mess, how do you even begin to stop that kind of bleeding?
Well, you pivot to extreme austerity.
Right.
The new internal corporate mandate under Stern is literally called business excellence.
Okay, business excellence. I feel like in the corporate world, that is very polite phrasing for ruthless cost cutting.
Oh, 100%. It means stabilizing cash flow by dismantling the very empire the previous executives built.
Got it. So what does that actually look like?
You exit internal manufacturing,
Yeah.
you outsource production,
Uh-huh.
you lay off staffs,
Mm-hmm.
and you shrink the physical footprint down to the absolute bare minimum.
Okay, let's unpack this. Because we hear about these corporate restructuring mandates all the time, right?
Sure.
But how is that actually reflecting on the balance sheet today? Because if you look at the current numbers from our sources, the data is deeply conflicting.
It is very messy right now.
Yeah, I mean, we are looking at top-line revenue that has completely stalled. It's flatlining at around $2.44 billion for the trailing 12 months.
Right.
And their trailing 12-month earnings per share is deeply negative. It's sitting at negative 12 cents. So growth is essentially dead.
Yeah, the growth story is definitely over for now.
Yet, and this is the wild part, when Wall Street looked at their Q1 fiscal year 26 earnings, Peloton suddenly posted a positive GAAP net income of $14 million.
Which shocked a lot of people.
Right. How do you post a profit when your sales are flatlining?
Well, achieving a positive GAAP net income with a flat top line is a massive indicator of how aggressive this business excellence mandate really is.
Okay.
They manufactured that profit entirely by putting on defensive armor.
Basically just slashing everything.
Yes. They aggressively slashed operating expenses, and they absolutely gutted their marketing budget.
Wow.
They are in a state of financial triage, largely because the debt load is, well, it's terrifying.
Just how bad is it?
They have $2.54 billion in total liabilities, towering over just $2.12 billion in total assets.
Correct.
That is a state of negative equity. The company technically owes more than it owns.
Yeah, which risks total insolvency.
Wow.
But management isn't just letting the ship sink.
They are aggressively deleveraging. They've pulled their total debt down year over year to $1.5 billion.
Okay, so they're making a dent.
They are, and they're sitting on a surprisingly robust cash position of $1.04 billion.
That's a lot of cash to have on hand for a distressed company.
It is, and the metric that is really turning heads, they are projecting $250 million in free cash flow this year.
Really?
Yeah. To give you a sense of the operational turnaround there, their operating cash flow to sales improved from a disastrous negative 56% to a positive 13.4%.
Wait, I have to push back on this a little bit.
Go for it.
Generating a profit by slashing all your marketing and R&D, I mean, that feels incredibly short-sighted.
It's definitely a risk.
It's like a farmer eating his seed corn or unplugging your life support machine just to save on the electric bill.
Yeah.
Sure, the quarterly balance sheet looks great today and you won't starve this winter, but you're guaranteeing you won't have a crop to harvest next year.
That's a very fair point.
Like, eventually, they need to acquire new users. You cannot cut your way to long-term prosperity.
And that exact tension is driving the intense skepticism around this stock. In fact, our sources point out a glaring red flag that validates your point completely.
Okay, what's the red flag?
The insider trading activity.
Oh, interesting.
Yeah. The average trading volume for Peloton is massive.
Yeah.
We're talking around 14 million shares changing hands every single day.
So there is intense market interest.
Huge interest.
Yeah.
But the people who actually run the company, the executives inside the building, looking at the raw internal retention data every single day,
Yeah.
they are not buying the stock at $4.56.
Ah. I mean, if the internal turnaround metrics were as rock solid as that $14 million profit suggests, those executives would be mortgaging their houses to buy shares at $4.
Exactly. And this raises an important question, right? This creates a fascinating divergence.
Right.
If the insiders are passing on a $4 stock, the people who are buying those 14 million shares a day must see a completely different horizon.
So let's look at that battle. Let's look at the bear case first, because it seems heavily grounded in the core mechanics of the business model.
It is.
The bearish argument from the analysis is that Peloton is a classic value trap.
Right, because Peloton isn't really a hardware company.
Exactly. That $2,000 stationary bike is just a physical Trojan horse, basically.
Yeah, designed to lock you into a $40 a month software subscription.
Right. And right now, that software engine is stalling.
Big time. Their connected fitness subscriptions are actually down 6% year over year.
Which is huge.
It is. Because when you factor in macroeconomic pressures like stubborn inflation, high interest rates, tightening household budgets, that $40 a month fitness app is one of the very first things a family cuts.
Right, the hardware gets you in the door, but the software is what actually pays the bills.
Exactly.
So if the subscriber base is shrinking, why does the stock occasionally shoot up 15% in a single afternoon?
Well, that's the squeeze setup.
Yeah.
With roughly 64.8 million shares sold short.
Wait, how much of the float is that?
That's over 16% of the public float.
Oh, wow. So Peloton is an absolute powder keg.
It really is. Any hint of positive news from the new CEO doesn't just attract organic buyers. It triggers mechanical short-covering rallies.
Right. The short sellers panic, they buy the stock to close their positions, and that drives the price up artificially fast.
Precisely.
So retail investors sitting at home see a 15% spike, they think the turnaround is fully underway, and they jump in.
Yeah, but it's often a mirage. Because when the short covering finishes, the demand evaporates and the stock collapses right back down.
It's a highly volatile landscape, but, and we have to be balanced here, we have to give equal weight to the bull case.
Oh, for sure. Which is championed by heavy hitters like activist investor Eric Jackson from EMJ Capital.
Right, and what's his argument?
His thesis is built heavily on valuation multiples and brand power. Because right now, Peloton's price-to-sales ratio is sitting at 0.74.
Wow.
And their forward price-to-earnings ratio is 12.6.
I mean, in the tech and consumer discretionary sectors, paying less than 75 cents for $1 of sales is almost unheard of.
It's crazy cheap.
Yeah. And a forward PE of 12 usually signals total market capitulation, like the market essentially assumes the company will never grow again.
Right, but Jackson argues the market is entirely mispricing the brand's incredible mindshare.
Okay, mindshare.
Yeah, like you cannot easily replicate Peloton's household recognition.
That's true. Everyone knows the name.
Exactly. Furthermore, he argues the users they have left are fiercely sticky.
Sticky!
Yeah. He actually uses his own wife as an example.
Oh, really?
Yeah. He says she is essentially a lifetime member because she absolutely adores a specific instructor.
Oh, that makes sense. People get very attached to those personalities.
They do. So his point is that the tourists who bought a bike out of pandemic boredom, they're already gone.
Right.
The subscriber base that remains is a hardened core of highly loyal users.
And the target prices from the analysts definitely reflect that optimism.
They really do.
I mean, we are looking at an analyst consensus target of $7.88. That would be a massive 73% upside from today. And our CFA source ran a discounted cash flow analysis and estimated a fair value of $8.32.
And Eric Jackson is going even further, predicting this could be a $40 plus stock in a few years if the turnaround initiatives truly take hold.
That would be wild. But here's where it gets really interesting. We have to look at what the trading algorithms are doing.
Yes, the technicals.
Right, because the technical indicators are flashing some very specific signals right now.
They are. The Relative Strength Index, or RSI, is sitting at 62.65, which is creeping into bullish territory.
Okay.
And the MACD, the moving average divergence, just registered a bullish crossover of 0.00097.
So in trading terms, the short-term downward velocity has exhausted itself.
Exactly. And institutional money is starting to push upward.
Okay, so the algorithms are flashing green.
Yeah.
And the order flow data from our sources shows massive institutional tripwires aggressively defending the $4.30 price point.
Right. Automated buy orders just keep catching the falling knife.
But I have to ask, does any of that short-term momentum matter if they're still stuck below their 200-day moving average?
Well, that is the ultimate algorithmic ceiling.
Right, because until it crosses that 200-day moving average, major hedge funds and institutional models will fundamentally view Peloton as a broken stock.
Yeah, technical charts bouncing off a $4.30 floor won't save them if the core business model is bleeding out.
Because you can't just play defense and cut costs forever. At some point, Peter Stern has to actually sell bikes again.
He does.
So where is that organic revenue supposed to come from if everyday consumers are tapped out by inflation?
Well, this is where Peloton's new strategic pivot becomes crucial.
Okay.
They know the direct-to-consumer subscriber base is shrinking, and it's getting way more expensive to acquire them.
Right.
So they are aggressively pushing into B2B business-to-business sales.
Okay.
They are targeting corporate wellness programs, luxury apartment complexes, and high-end commercial gyms.
So selling fleets of bikes to a single buyer instead of fighting for individual household sales.
Exactly. And the corporate wellness market alone is estimated to be 10 times the size of the market Peloton is currently operating in.
10 times?
10 times. It is a highly fragmented market filled with legacy equipment providers that have, frankly, zero modern brand recognition.
Right, like the clunky old bikes you see in hotel gyms.
Exactly. So
Yeah.
Peloton walks into that space as an absolute giant.
I imagine the software margins on commercial licenses are fundamentally different, too.
Oh, completely.
Right, like if a luxury hotel buys 10 bikes, they're buying an overarching commercial subscription to justify raising their room rates.
Yes.
That is a captive audience, and it's highly predictable recurring revenue that doesn't churn just because, grocery prices went up.
It completely changes their customer acquisition cost.
That makes a lot of sense.
And in addition to the commercial hardware push, they are launching Peloton IQ to monetize the digital side of the business.
Okay, what is Peloton IQ?
So they have years of granular proprietary data on user workout habits, heart rates, class engagement, and retention metrics. Yeah, and they are figuring out how to package and sell that intelligence.
See, selling bulk hardware to a gym solves the inventory problem, but the real goldmine isn't the metal bikes. It's that massive biometric data set they've been collecting from users for half a decade.
Exactly. Add to that the launch of Peloton Repowered.
Who coward?
Yeah, it's an official program to sell certified refurbished bikes.
Oh, smart.
Very smart.
Uh,
This allows them to tap into a much more price-sensitive demographic, like people who want the brand but just can't stomach a $2,000 price tag up front.
and because it's an official certified refurbished program, it protects the prestige of the brand.
Right.
It doesn't cheapen their core premium image the way a desperate 50% off clearance sale would.
Exactly. So if
Yeah.
we connect all of this to the bigger picture,
Yeah.
Peloton right now is serving as a fascinating masterclass in corporate financial triage.
It really is.
They're undeniably distressed, right? Weighed down by the massive structural ghosts of their pandemic-era expansion.
Yeah.
But for the first time in their history, they are showing genuine, ruthless, operational discipline.
So they survived the frantic sprint, and now they are systematically trying to rebuild the treadmill while it's still running.
It is a race against the clock.
It really is. So, to wrap this all up, we've taken you on quite a journey today through Peloton's massive debt loads, their conflicting technical charts, and their desperate strategic pivots.
We covered a lot.
We did. And the ultimate tension we are left with is this. Peloton has successfully manufactured a quarterly profit through extreme, painful austerity.
Right.
But survival is not growth. Their ultimate fate depends entirely on whether these new commercial B2B initiatives, the monetized data from Peloton IQ, and the refurbished sales can scale up fast enough.
Fast enough to replace the direct-to-consumer subscribers they are actively losing.
Exactly.
Because the fundamental question is whether the brand loyalty Eric Jackson points to is strong enough to carry them across the chasm while they execute this pivot.
And before we go, I want to leave you with one final thought to mull over as you watch this story unfold.
Yeah.
We talked about Peloton trying to monetize their massive user data with Peloton IQ and moving heavily into bulk corporate B2B sales.
Right.
If these initiatives actually succeed 5 years from now, will we even consider Peloton a fitness company anymore?
Oh, wow.
Or will they have quietly transformed into a massive global health data broker that just happens to sell stationary bikes on the side?
Honestly, that outcome fundamentally rewrites the entire valuation model of the company.
It changes everything. It means we aren't just stepping off the runaway treadmill. We are dismantling it and selling the sensors.
Yeah, that's fascinating.
Well, thank you for joining us on this deep dive into the numbers, the noise, and the strategy. Keep questioning the data, keep exploring the bigger picture, and we will see you next time.
Take care, everyone.